Hello, I'm Holger Meurer. I work in Global Accounting Consulting Services at PwC. Welcome to an episode of our series of videos in which we present to you the highlights of the new lease standard. One of the most important challenges of the new standard is the accounting for variable lease payments. The standard distinguishes between three different kinds of variable lease payments, each of which is accounted for differently.
First, there are variable lease payments based on an index or a rate. For example, lease payments linked to a consumer price index, a benchmark interest rate, or a market rental rate. These are part of the lease liability. On initial recognition, they are included in the lease liability using the index or the rate at the commencement date. Hence, a lessee does not forecast future changes of the index or the rate. In subsequent periods, changes in the variable lease payments trigger a remeasurement of the lease liability only at that point in time in which lease payments change. Let's have a look at an example. An entity operating in an inflationary environment entered into a 10-year lease contract with annual lease payments of $50,000 payable at the beginning of each year. Every 2 years, lease payments will be adjusted to reflect changes in the consumer price index for the preceding 24 months. At the commencement date, the consumer price index was 125. At the beginning of the second year, the consumer price index is 130. At the beginning of the third year, the consumer price index is 135. On initial recognition, the lease liability is calculated based on the contractual lease payments of $50,000 for each year. Even if the consumer price index has changed at the beginning of the second period, the entity will not remeasure its lease liability because a change in cash flows has not occurred. At the beginning of the third year, the lease payments change to $54,000, that is 50,000 times 135 divided by 125. As the cash flows now have changed, the lease liability has to be adjusted. The lease liability is remeasured to reflect the outstanding 8 payments of $54,000 using the unchanged discount rate. A corresponding adjustment is made to the right-of-use asset. The income statement effect will be made via the change in the depreciation and interest charges. Variable lease payments that are not based on an index or a rate are not part of the lease liability. These include payments linked to a lessee's performance derived from the underlying asset, such as payments of a specified percentage of sales made from a retail store, or payments based on the output of a solar or a wind farm. Similarly, payments linked to the use of the underlying asset are also excluded from the lease liability, such as payments if the lessee exceeds a specified mileage. Such payments are recognized in profit or loss in the period in which the event or the condition that triggers those payments occurs. The last category of variable lease payments are so-called in-substance fixed payments. Lease payments that in form contain variability, but in substance are fixed, are included in the lease liability. In practice, it will be very difficult and judgmental to assess whether variable lease payments meet the definition of in-substance fixed lease payments. The only hint IFRS 16 gives is that lease payment is in substance fixed if there is no genuine variability. As an example, a scenario is described where payments must be made if the asset is proven to be capable of operating, or where payments must only be made if an event occurs that has no genuine possibility of not occurring. If payments initially structured as variable lease payments linked to the use of the underlying asset, but the variability will be resolved at a later point in time, those payments become in-substance fixed payments when the variability is resolved.
For entities, the distinction between these kinds of variable lease payments is crucial, as it has significant impact on the accounting and as a consequence on KPIs. So for example, for an entity that enters into a lease contract for which all lease payments solely depend on the performance of the leased asset, the right-of-use asset and the corresponding lease liability might be almost close to zero. Eventually, it's accounted for similar to a current operating lease. Thank you very much.
Our range of publications on IFRS 16 leases provides more information on the practical application of the new standard and is available on PwC Inform. If you have additional questions, please reach out to your local PwC contact.